Hello, my name is Juliet Peña, and today I'm going to be talking about the alternative minimum tax. The topics I will be discussing are the basics of alternative minimum tax, AMT adjustments, and AMT exceptions and calculations. What is the alternative minimum tax? So, it is an additional tax system in the United States designed to ensure that high income individuals pay their fair share of taxes. Basically, it ensures that those in higher tax brackets who might escape taxation by using tax incentives pay a certain minimum amount of income tax. There is a reason for this additional tax code, and this all started in 1969 when lawmakers looked at the codes and who's filing taxes, and they noticed that those with high income had a lot of deductions and were paying really low in tax at the end of the day. So, to make things fair, that's when they introduced the second system. Basically, the committee believed that it was unfair for high income individuals and profitable corporations to pay little or no tax due to their ability to use several tax preferences. So, under the alternative minimum tax, what they do is that they take a number of deductions and credits that you have available under the traditional tax code and they add them back onto your income when they are calculating AMT. So, for example, the standard tax deduction is not available under the alternative minimum tax. They add it right back onto your taxable income for the year. So typically, under the traditional tax codes, you also get deductions and credits for things like taxes that you already pay to the states or local and foreign governments. But unfortunately, those are also not available under the alternative minimum tax calculation. The alternative minimum tax system has some exception amounts. The AMT exception limit for 2024 is 133,300 for married couples filing jointly and 85,700 for singles. Depending on the income liable for taxation, alternative minimum taxes are applied at 26% and 28%. AMT exceptions are phased out at 609,350 for single filers and at 1,218,700 for married couples filing jointly. Okay, so to determine the alternative minimum taxable income, the taxpayer starts with regular taxable income, as you can see, and then the taxpayer makes adjustments to regular taxable income to arrive at the alternative minimum taxable income, which is used to calculate the minimum tax liability. The AMT rate is either 26% or 28%, as I had said before. If the taxpayer's alternative minimum taxable income is 220,700 or less, the AMT rate is 26%. On the opposite, if the alternative minimum taxable income amount is more than 220,700, then the AMT rate is 28%. So now it is important to note that a taxpayer doesn't owe any AMT unless the AMT calculation results in an amount higher tax than the regular tax code. So if you recall, the top regular tax rate in the traditional tax code is 37%, and the top AMT rate is 28%. So most high-income taxpayers will pay more under the regular tax system. Only taxpayers with significant special adjustments will be subject to AMT. The form of calculating your taxes to make sure that you're paying a certain amount is for extremely high income earning people. And what they do is they calculate their taxes both ways. They calculate it the traditional way and they calculate it under the way of the alternative minimum tax. Then they look at those numbers, the two totals that they have, and they pay the higher of the two. So, as an example, let's say that we have someone who's subject to the alternative minimum tax, and under the traditional tax code, they owe $10,000 in taxes, but under the alternative minimum tax, they owe $20,000. That means they will have to pay the higher number of $20,000 that they are subjected to under the alternative minimum tax calculation. Something important to note is that the AMT for an individual taxpayer is reported on Form 6251. Let's see an example now. Shane is a single taxpayer with a minimum alternative income tax amount of $300,000. Under the traditional form of calculating taxes, he owed $55,000. So first, what you should do is subtract the AMT exception limit, which is $85,700, from the $300,000 taxable income. Depending on the total income amount that is obtained after this calculation, the final figure is calculated by multiplying it with either 26% or 28%. The income amount is $214,300 after subtracting the AMT exception. We then multiply this amount by 28% and we get the tax liability of $60,004. Now we compare this figure with the calculated for regular income tax. So Shane's liability will be the higher figure of either amount. So in this case, for Shane, we are assuming that on the traditional form of calculating taxes, he owed $55,000. Then we go to the alternative minimum tax calculation, and he's owing $60,004. This means that he will pay the higher of the two, which could be the $60,004. Lastly, it is important for you to stay informed about changes in the AMT rules and exceptions to ensure you are prepared for any potential impact on your tax situation and to help navigate the complexities of the AMT system. Thank you.